Did you know that in Canada, two people could earn the exact same 7% return and one of them would walk away with twice as much money as the other? It's not about what you earn, it's the tax classification of the income. Today, I'm pulling back the curtain on a specific tax tool called return of capital, which the wealthy use to shelter their cash flow from the CRA. Not all income is created equal. I'm PV, CPA, CA, and trustee at Foundation Capital Private Real Estate Trust. In the Canadian tax system, the CRA views your money in different buckets. Bucket one is interest. This can come from bank interest, GICs, or even private lending. It's the most expensive income because the CRA treats it just like a salary and taxes it at your highest rate. Then you have bucket two, which is dividends. Better, but they're still taxed. Then there's bucket three, return of capital. This is considered the holy grail of cash flow investors because it's considered non-taxable in the year that you receive it. So how is it possible to get a monthly check and not pay any tax? Think of ROC like this. The investment is simply giving you a portion of your initial investment back while the underlying asset continues to grow in value. In the world of real estate, we use something called depreciation or CCA here in Canada. This is a paper expense that offsets rental income. So even though this building is making a profit and sending you cash every month, that income is shielded. What this does is lower your adjusted cost basis. You don't pay taxes today, you defer it until you sell the asset down the road. And when you do finally pay, it's taxed as a capital gain. So you only pay taxes on half the profit. So you've deferred your taxes and you've cut your tax bill in half. Let's look at a real world example of how we apply this at Foundation Capital Private Real Estate Trust. We invest in apartment buildings across southwestern Ontario and we offer a 15% plus targeted annual return. So now let's break out that return into the two components. One component is an 8% plus appreciation in the value of your units. And then the other component is a 7% cash flow distribution paid on a monthly basis. Because of the way we're structured and the way we manage the portfolio, that 7% annualized cash flow distribution, which is paid on a monthly basis, is currently 100% return of capital. So if you invest $100,000, you're getting $7,000 a year, which goes straight into your pocket, not to the CRA. Versus if you had invested in a GIC, you'd only keep $4,000 and approximately $3,000 would be going to the CRA. With FCPRET, the full $7,000 stays with you today. That extra $3,000 stays with you and compounds for your future, not the government. So as we start 2026, remember your TFSA contribution limit has increased by another $7,000. So make sure you max that out and use it to invest and grow for your future. Additionally, you have up until March 2nd to contribute to your RRSP. Take the tax deduction, save on your taxes now, have your investment grow within your RRSP for the future. And then when it comes to cash investments or non-registered accounts, make sure you utilize powerful tools like return on capital to keep more money in your pocket today and pay less taxes in the future. My goal with these videos is to help you stop looking at top line returns and look at what you actually get to keep. So if you want to dive deeper into the math behind ROC, or you're interested in passively investing in Canadian apartment buildings without having to deal with any of the landlord headaches, click the link in the description and book a discovery call with us to learn more. Remember, here at Foundation Capital, we're not just managing assets, we're building yours. See you guys in the next one.